Good morning. Welcome to SOXX Insights. Today is October 24th, Friday. We have just seen the release of the latest CPI data from September. The data was released 2 weeks late due to the government shutdown, but at least we have got it now before the month end. And it has been positive. Things are moving in the direction that the White House wants, the Fed wants, and it will confirm that the Fed will continue cutting into the year end. So the headline CPI was higher year on year than the previous month at 3%, but that's mostly due to a surge in energy prices during the month. And typically, because energy prices fluctuate so much, this is something the market, the Fed, largely ignore, unless energy prices are sustainably higher as a trend, which doesn't seem to be the case right now. And we'll talk more about oil later on, but this isn't a concern for the market. Looking at the core CPI, it actually came in lower, 3% year on year, against 3.1% in July and August. So this is a welcomed deceleration. We were slightly worried about a sticky core CPI back in July and August, but things are moving in the right direction again. So the Fed will take this as a signal that they are able to cut rates to accommodate for the labor market instead. Just looking at more details, so the sticky part of core inflation, which is shelter, has actually been moving down in the past 4 months in terms of year-on-year increases. That is a very encouraging trend because shelter was the component that makes up 60% of CPI, but the Fed couldn't quite get it down last year. But now it is moving down. It's still quite high, 3.5% to 4%. But now it's trending in the right direction. So that gives the market some assurances that the overall CPI should head lower, given it's such a big, heavily weighted basket. Transportation services that rose sharply in terms of motor vehicle insurance and repair back in August, now is coming down again. So right direction, same as insurance, coming down again sustainably from a few months ago. And airline fares still quite high, 3%, but it is okay against the broader CPI. Looking at the S&P 500 year-to-date performance, we're back to 15.5% return. So we're now in the top half of performers in the past decade. From here onwards, the stock market is likely to make new highs by the year end, and very unlikely to end the year below the double digit. And we are now in a historically bullish period between the second half of October and almost entire November, except for a couple of days over here. So I think with the benign CPI figures, Fed reaffirming they're going to cut rates, and a lot of people still fearful of this rally. You can see in the greed and fear index, we recently reached sub 30 level. I think money could start moving back into the market again. And I do think stocks and crypto will both rise into the year end. Something I have been tracking is the changes in credit spreads. So the high yield credit spread is at the bottom pane. We are seeing 4 consecutive rises of positive spreads widening. So that means the credit investors are getting a little bit cautious. They're demanding more yields for the same risk assets. So that means the prices of the credit debts are going lower. And we did see this in December last year. We did have a little drawdown in December last year. But we are not at the 2 standard deviation level where things are extremely concerning. So, for example, beginning of 2024, the carry trade unwind back in the summer of 2024 and the tariff sell-off in March and April. We're not at those levels yet. So I do think if we get pullbacks in the coming weeks, the pullbacks could be quite shallow, especially given the strength of this bull market. And looking at the volatility score, so this is the S&P 500 at the top, SPY ETF, and this is my proprietary volatility Z-score indicator. I have incorporated this into TrendSpider, and I will be sharing this for free in the next couple of weeks. Simply put, this is a rolling 21-day volatility measure compared against its 1-year average. And the red line here is a 2 standard deviation. The yellow line is 1 standard deviation. This gray line here is the average, and over here is the -1 or 2 standard deviations, which means very low volatility. So actually, SPY is trading at its historical average volatility, and we're not seeing extreme market stress like we did August 2024 or March, April 2025. So largely speaking, over here, things are going to be fairly benign unless we are seeing a sharp rise of this measure in terms of momentum heading above across the Z-scores. So we did see back in 2023 that it moved from -2 to the average, so across 2 Z-scores. So that was corresponding with a negative performance period for SPY. And at the moment, we have moved about 1 from the -1 to average. So I think if we start moving higher from here, then we should start getting a bit more cautious. Right now, things are going to be okay in the short term. If you look at gold volatility, so volatility doesn't necessarily mean things are going bad. The price could rise sharply with higher volatility. But what tends to happen is if you have a spike in volatility, it usually shows a blow-off period where things are moving really fast, people are chasing the market, and it takes a while afterwards to consolidate and digest the big moves that were made. So if you look at historically where gold had a spike, April 23, July 24, end of last year, and then beginning of this year, is accompanied by a period of consolidation afterwards. And the bigger the spike, the longer it takes to consolidate and for the volatility to come back down again. So what we're seeing here is a sharp rise in volatility again in gold in the more recent days as people, especially even retail, are now chasing after. I have seen pictures and videos of people really lining up in the physical gold stores across the world to get their share of gold at all-time highs. So I am not surprised that if we get a pullback and consolidate for a little bit in the coming month. And it doesn't really mean the gold top is in. This is the end of the cycle. It just means we need some time to consolidate the rally that has been. And now let's look at the gold versus Bitcoin chart that has been helpful for guiding us largely for the large part of the past 2 years. What we see is that gold leads Bitcoin by roughly 60 trading days. And this is not a coincidence. Both gold and Bitcoin are impacted by the rise in global liquidity, but at different speed. So when we have a rise in liquidity, gold investors tend to come in first. So the gold market benefits after 3-4 weeks, whereas the Bitcoin market, the crypto market, benefits after about 11 to 12 weeks. So that is the reason why we have a 60-day lag between gold and Bitcoin. And what we see is that gold was in a consolidation period in April to July, and it started to warm up in August and then went parabolic in September. And if we map out where Bitcoin is now, it's very to the gold performance back in August to July. This sideways period where the buyers get knocked out, the sellers get knocked out in both directions. But of course, with higher volatility than gold, Bitcoin is only 10% of the gold market cap. So the gold volatility is much smaller, even with the parabolic rise, is actually not that big compared to what you would gain in a crypto cycle. What we need to watch out is that, so while we are now entering a period where 60 days ago gold started taking off, it doesn't mean Bitcoin will rally straight up straight away. Bitcoin can still make new lows as gold in the initial period of recovery, but not too much lower than before. And then it starts to warm up and catch up with this correlation trade with like gold did before due to the liquidity. So I would be very cautious on the micro scale in trying to map out the daily moves of what gold did 60 days ago versus what Bitcoin does now. But I think on the grander multi-week, multi-month scale, when you zoom out, that lead is quite clear, and directionally, Bitcoin is bullish into the year end. So looking at SPY, the market has just opened. And what we see is that the market gaps open today on the back of positive CPI news. I do think this wave 4 is most likely complete by now in a single day candle. If it hasn't, so there is a chance this is a wave A, B, C correction, which will test the 50-day moving average again. I don't think the low will be much lower than what we traded, if at all, on October 10th. So the overall stance of the market is actually very bullish now. We had a couple of stress points in the past month, which is only natural given the extent of this rally from May. And I do think wave 5, we could target 690 to even 700. And that's simply the 1.38 above extension of the wave 4 from here. Similarly, QQQ is in a very nice rising channel that have held over the past 5 months. We didn't even test the 50-day moving average at the beginning of the month. So I do think the wave 5 could reach somewhere between 620 to even 640 at a stretch. So there is still some mileage in this. And given the large volume profile you see building over here and very similar in SPY, I cannot see a big correction falling significantly below this region, especially below the 50-day. There are too many investors who are interested in dip buying if the price retests this region. As you can see in the past couple of days, the candle held very well in the 600 area. So now on yields, once breaching the 200-day moving average, the 30-year yield has played like a textbook. So we saw a retest in this smaller degree wave 4, and then a direct move down to wave 5 in the 4.5% area that we have been highlighting for weeks, if not months now. Now we have reached this target area. I do think there is now a shifting probability for bounce in this wave 4. And this large degree wave 4 could test the 50-day moving average. So the 50-day will catch up down here, and we could test something like 4.7 or high 4.6% region for a bounce, and before making the final low in wave 5 of the larger degree. What could shift the bond yield outlook to higher? I do think the market has aggressively priced in a lot of Fed cuts for the next 2 years, and the market is projecting a below 3% terminal yield in this rate cut cycle. And in the short term, we could see the Fed keep saying that they're data dependent, and that could walk back some of the cutting expectations in the short term. And we can see yields just trying to find a bounce after the FOMC. So I think that is very feasible, especially when traders tend to buy the rumor and sell the news. So that sort of dynamic can push the yields higher, which is actually a good entry for bond buyers. So when we look at TLT, we have reached all 5 waves of this wave 3 target at 92, exactly at 92, like what we projected. And now I think we could retest lower for this wave 4, and that could probably find support in this 88 region, 89 region at the 50-day moving average, but also this volume profile over here. US oil is a very interesting case because it reached that wave 3 target pretty much slightly short, but sufficiently so, and it moved directionally. It moved back directly high above this support region and now testing the 200-day moving average. But the thing is, for the bulls, there is a huge mountain of volume profile to climb where people are probably interested in offloading their position, with especially more supply coming to the market in the next 12 months from OPEC countries. And what I think is likely going to happen is a retest lower to move below this region and then towards our wave 5 target. So where could wave 5 go? So let's say we end our rally around where we are now, then wave 5 could test 62 to 64 or even down to 61. I think this is very feasible, maybe not before the year end, but very possible into the coming year. And we are seeing a correlation between oil prices and inflation expectation, which then drive the yields. So what we saw was that oil prices dropped, yields also followed in this period. And now oil is moving higher, and we're seeing yields are also bouncing in the previous charts. So I do think the next move lower in oil, which will also support lower CPI levels from energy, should drive yields even lower into a new low. So here is probably the topic that everyone wants to know: is Bitcoin going higher or lower next? So given our upward bias from the gold versus Bitcoin analysis, I still want to see the bigger picture first before going to the micro structure. Where we are now, I don't even need to draw a trend line. It's very clear that we are retesting the highs of 2024 to the first half of 2025. And if you just look at where we are trading now, this is almost the perfect resistance zone from early 2025. We tested this a few times and couldn't get over. And then finally we moved over, and this becomes now the support region over here. And you can see this, and you can see this region as a very key supportive area right now. Once Bitcoin exits upwards from here, I think the road is probably very clear to much higher 140K, 150K potentially. But within this danger zone, and hopefully it doesn't slip lower from here, I think the risk is more balanced. And now zooming into the Bitcoin chart, what we see is that we have tested this short-term support area a few times, and Bitcoin has held. And now this region coincides with the 200-day moving average. Bitcoin has managed to stay above it. So that's very positive. I think the CPI data has helped slightly as well. But what we really want to see is a successful climb above this 50-day moving average. Then we can start thinking about this wave 5 here. In the very short term, over here, I would say Bitcoin is effectively stuck between the moving averages and the support region. So our model signal has been in the past couple of days, which is constructive. But if you are a bit more cautious about Bitcoin being stuck in this region, you could wait for the 50-day as a more clear signal for the momentum upwards. And once we exit this sticky area, I think we could test 140K in the next rally. Ether has been a little bit more risk-off than Bitcoin. Our model signal has been on zero in the past few days. And I think there are a few hills for Ether to climb. So we have the 50 moving average here, a large volume profile of investors who probably bought over those levels when Ethereum couldn't break above this resistance zone. And what could happen is people are offloading in the short term when we get to this level. And then, of course, we have this 3-month resistance area where Ether couldn't break above before. But I do think the biggest downside move is now behind us. We could even retest into the 3,300, 3,400 region, but I cannot see Ethereum going significantly below it. So here is the 1.236 extension of this wave A, which is typically the termination zone for wave C. We have rising volume profile in this region as support and the 200-day moving average. So if I were to go long here and put a stop for in anticipation for the year-end rally, I would set it probably below the 200-day moving average. Moving below here, I think we can gap down quite quickly to the mid-2000. Solana, it does look like we completed this wave C more or less against this wave A. We tested this 100 to 223% extension, and every time it touched the 200-day moving average is held. So we've done this 4 times now. So it does seem that there's a lot of support in this region. And if I were to look at the volume as well over here, there is a big volume profile precisely between the 200-day and 50-day moving average. So I think Solana is probably building a base here. The thing about Solana is that it hasn't received the institutional favor as much as a Bitcoin or Ether have. BlackRock isn't launching a Solana ETF anytime soon. So the liquidity for the Solana market is a bit smaller. And you can see that in terms of trading volume as well. It tends to swap places as the number 3 with Ripple, but it doesn't always hold that spot. And zooming out, there is this resistance level at the 260, 270 region. If we use the 100% extension of this wave 1 as a guide for where wave 5 can head, I think 350 is a reasonable target. But the overall trend has been a bit less bullish. We haven't even climbed over the January high yet. So I would prioritize Bitcoin and Ether in terms of my holdings. Coinbase, we have seen an encouraging bounce after the sell-off early in the week. So it's up about 6% after the market open. And I do think this is wave 1 and this is wave 2, and we can test wave 3 in the 500 mark. So that offers pretty good risk reward against this wave 4 low here. So a pattern I've spotted is using the Ichimoku cloud. So around the same time last year, we had a rise pullback into the cloud and retest the cloud low. And this time we also have the same pattern where we have a rally pullback into the cloud and then retesting the cloud low this week. And we are now bouncing off this. So if the history is of guidance, this rally was pretty insane. It was a 100% rally from the bottom of this cloud into December. I'm a bit more conservative about another 100% rally from here, but this would line up well with our overall chart count towards the $500 mark. Hood, I have been pretty bullish on Hood in terms of the overall structure. I did think before today there was a very good chance for wave 5 high, and I think today's bounce will confirm this wave 5 starting. So overall, we are seeing an expanded ending diagonal where this wave 4 overlaps with wave 1 slightly, and wave 5 could reach 170 or just below that. Gold. So I have been asked a few times about gold this week, given the size of the pullback. So we predicted this rally back in August. And if you looked at my analysis back then, we clearly laid out the map for the next rally. But the extent of this rally exceeded my expectation by far. So when you get something like a parabolic rally, it is really difficult to predict exactly where it's going to top. And the only thing you could do is essentially follow the price action and set a trading stop of some sort, for example, 3%, 5% below the trading level, and you exit the position and take profit. But now we're looking at the technicals after this fall. We haven't got to the 0.38 retrace of this wave 3 yet. So there is more room to go. Potentially after bounce, we can have an ABC correction where we test 360, and potentially the 50-day moving average will have caught up by then and to support the price around this level. I don't see this as the top, given what we said at the beginning of this webinar, but also technically speaking, when we have this rally, there will be people who are still interested in buying. They've been waiting for this pullback, and they will be eyeing for one more high. And GLD could well reach in the 420s or even mid 400 after this pullback. Apple's chart has been really clear, actually. After the jump in early August above this 200-day moving average, it was very clear this is a 5-wave rally within the third wave, and we recently had a wave 4 pullback. So now starting wave 5. Wave 5 could target 300. So far, nothing is out of our expectations, so we just keep monitoring this. Amazon, pretty encouraging open today. We have climbed above this trend line from early September, so that's a good thing, as well as this volume profile. So now this could potentially develop into a base if we close above it. So now we just really want to see closing above the 50-day moving average, and then we can start believing wave 5 towards the 250 mark or even 260 in the next move. Google also been very bullish. We had an intraday fall after the ChatGPT announced its own browser. To be honest, I tested the browser. It's okay. There are some lags between the tabs on what I'm searching. It's not as intuitive. So it is relying on people to redevelop their habit because they're reimagining the browser using AI. But there's also a Google search tool top right of the browser anyway, which directs to Google search. So the market reclaimed this high already within this week, and I think we're just moving towards this target of just below 300 to 90 potentially in this wave 5. Meta, my technical read actually has been pretty spot on regarding the size of this correction. We bottomed in this wave C in early October, and then it's been moving sideways. So if you bought around here, you'd be slightly in the money. But of course, the challenge is that once you have a multi-month correction or consolidation, the initial momentum for recovery is a bit slow as investors still building out the space in this region, trying to test the 50-day moving average. And once we move above this, we can start looking at 840 or even 900 in this wave 5. I think on the balance, I favor a post-earning pop rather than drop after next week. Microsoft, my read for Microsoft has been very different to the others. I think it moved up very aggressively back in early summer, and we are still in the digesting period where volatility is getting a bit bigger. You can see large red candles on certain days, which didn't used to have back in early summer. So the market is a bit free roaming now after the last earnings set. What I read this is a ABC move. So it's a corrective rally of this wave B, which means I do expect there to be one more low in this wave C from this high. We are moving higher though, so we're above the 50 moving average, above this volume profile. So I could be wrong, but I want to see solid evidence of Microsoft taking out 530 decisively to then readjust my read. This could easily develop into a head and shoulder pattern next. So that's something we need to watch out for. NVDA. So I have been quite bullish on NVDA, especially when it was testing this supporting region. So it did feel a bit unnerving where the sellers have been pretty aggressive. But NVIDIA has always closed above the 50-day moving average. So you can see in the past 2 weeks, even when it consolidated in this narrow price range, every time it tested below the 50-day, it closed above it. So that is very good evidence of the bulls still in control. And now we're moving back towards the height of this channel. I do think we will get to 100 potentially before the year end in this wave 5. Tesla. So Tesla is a difficult case actually because we had ABC correction, but the shallowness of this correction left wave 4 a bit unsatisfied, in my opinion. So I have been expecting a deeper pullback. After earnings, we got a 4% pullback, and then we rallied 8% intraday into a high close. But if you notice, this yesterday's close was still below this wave B high here, and we're now dropping 2% at open today. So that to me doesn't quite solve the mystery of whether we will get one more low or not. I rather watch the market a bit more. If we get breakout here, then we can start looking at, okay, moving towards mid 500s for this wave 5, still decent gains to be made. But otherwise, if you're patient, you can wait and potentially below 400 for even better price entry. PLTR, it has moved sideways for the large part of the past 1 month. That's not a bad thing. That appeared to be a wave 4 consolidation with volume building. The price hasn't collapsed from here, which suggests people are actually still accumulating in this region rather than distributing. And we could be testing wave 5 next. And I do see the wave 5 target to be 200. After we get to this target, I think even if it stretches, I think things will get more difficult for PLTR. SOXX is just been incredibly difficult to try to preempt the pullback. We had this 1-day pullback, but it did feel very unsatisfying for wave 4 here. So preliminary, I am still ruling this as part of the wave 5. So I do want to see a deeper pullback, ideally into this area, 270 region, where there's volume profile and 50-day moving average for a better entry against the wave 5 target. So that's it for today. Thank you for watching, and we'll discuss again next week.